Ladies and gentlemen, we are going to get straight into this video because this video is so much more interesting than the previous videos. We're starting to get into some really important concepts and topics here, which is crucial for you to understand to be able to be a profitable trader in the foreign exchange market. So let's get into it. What makes the markets actually move? A lot of retail traders, they don't know this. So you're about to learn it now. Alrighty, so what are market makers? Now, market makers are really crucial in the functionality of the financial market. So market makers are different financial institutions like banks and brokers, where their responsibility is to provide liquidity for you guys and therefore enable trading to occur. Because, without them, you guys wouldn't be able to place buy and sell positions in the market. And that essentially allows for a smoothly traded and liquid market for everybody. And they'll often take the counterparty trade when a trade is made, buying from a seller or selling to a buyer. And by doing this, there will always be a counterparty you can trade with when trading FX. Now, a lot of you guys have probably heard the term market equilibrium. Now, that pretty much sums up that concept, but we're going to get into that in future lessons as well. So market makers will quote two prices for a currency pair, being the bid price and the ask price, which is the sell price. The difference between these prices is called the spread, which is what the market maker collects and how the market makers are compensated for being the counterparty for the wider market's trades. I hope that sort of makes sense, guys. That's essentially how they get paid. So it doesn't matter if you lose a trade or you win a trade, they're still collecting that compensation, that spread. Now, this concept will be discussed in greater detail later on in future slides and lessons as well. Now, it is in their function to take the opposite trade to any given market participant, and market makers are constantly hedging their position and adjusting prices based on their inventory levels to ensure they have consistently managed their risk while setting fair prices for market efficiency. So in future lessons, I was talking about what makes a good broker and a bad broker. And I was talking about brokers not segregating client funds. Now, this last paragraph here, you want to make sure that they do segregate client funds, because they will, if it's not segregated, they will use your money to control their risk. And you don't want that, because you don't want to be taking additional risk in case that brokerage, falls to shit, essentially. Now, I'm just going to make my head a little bit smaller there so you can see the entire slide. But let's talk about the main market participants now. Some of the main market participants are central banks, commercial banks, corporations, governments, and sovereign wealth funds, and brokers. Now, retail traders also have an influence in the participation of the foreign exchange market, but their significance is minor compared to these huge market makers. Now, let's talk about these market makers individually so you get an understanding of their role in the foreign exchange market. So central banks play a huge role in the foreign exchange market through their monetary policies and interventions. By setting interest rates, they influence the attractiveness of their currency. So if interest rates are higher, it's going to be more attractive for investors because the yield is a lot higher when interest rates are higher. So if people are investing in bonds, they're going to get paid more. If interest rates are lower, they don't get as much money. So they typically tend to place their capital in safe havens like gold or different commodities or a different economy altogether. It might be the yen, for example, until, obviously the US raises interest rates. And central banks also engage in direct market interventions by selling or buying their currency to stabilize or adjust its value to meet economic objectives. That is also another big fact for central banks, which we'll dive into soon as well. Now, commercial banks, they facilitate the bulk of forex trading, and they act as intermediaries for other market participants such as corporations and investors. Goldman Sachs is one of them. That's why you can see that photo there. They provide liquidity to the other market by offering buy and sell quotes for various currencies. So essentially they're the middleman. Their trading desks engage in speculative trading and hedging activities, influencing exchange rates through their sizable transactions. So, a lot of that in between those large transactions, if a foreign company is buying a US company or a US company is buying a foreign company or they're merging, those large transactions, depending on what currency they're converting the capital into, that's going to have a direct effect on the financial markets. Now, let's talk about government. So they influence the foreign exchange market through their fiscal policies, political action, and economic data releases. Economic data releases are huge, and it's usually the forecast. The forecast is when you typically see that move start to actually occur. So just recently, a couple of months ago, or about a month ago, I was bearish on the United States dollar because the forecast for interest rates being cut was about 83%. It was an 83% chance that the US was going to cut rates, and price was consolidating just as that sort of forecast came out. Then that forecast actually implemented that negative effect on the United States dollar, and we saw a huge trough in price for the United States dollar. And then obviously we had the release, and you do get a little bit of a move on the release if it's completely different to the forecast. Usually you'll have a bigger reaction if it's completely different from the forecast. Now, policies related to taxation, government spending, and trade tariffs can affect economic performance and investor sentiment, thereby impacting a currency's value. Now, political events such as elections or geopolitical tensions can also lead to currency fluctuations. Now, the political sort of stance and geopolitical stance can be a little bit hard to track because usually you have to monitor news a lot more frequently. There's not typically, you can see the times that, huge market participants are actually having meetings. So it might be a FOMC meeting, or there's a certain speech occurring. Now, during those times, you don't know what they're going to say that's going to have either a positive or negative effect. You can have an inclination, some idea on what they're going to say, depending on the economy's health leading up to that speech or that event. But they are very volatile, and they can vary depending on what's said and what's done during those meetings or speeches. So it's just any speeches or events like that that are up and coming, you need to have an idea of the economy's health overall, but also you just need to be careful of that event and monitor your risk and manage your risk during that time as well, because they can be quite volatile. Now, sovereign wealth funds. So they manage large pools of capital on behalf of their respective governments. Their investment decisions, including the diversification of assets across different currencies, can lead to significant movements in the foreign exchange market. Now, large-scale purchases or sales of assets in foreign currencies can influence exchange rates, which is what we were talking about before, right? So those large transactions, as we can see over here, in the right, we can see the funds under management. It's a lot. That's what, 1.3 trillion. It's a lot of money. So any transactions that's occurring between these entities, that all has a direct impact on the foreign exchange market, depending on the size of the transaction. So that's why I love the foreign exchange market, because it's always going to be here. As long as the world is operating, the foreign exchange market's going to be here. Crypto, it isn't like that. It doesn't need to be here. It's only just sort of becoming a large form of currency, and huge governments, funds and institutions, they're not using crypto primarily for transactions. They're using currency, and that's why I love the foreign exchange market, guys. So it's good to be able to understand these topics, to have an idea on what's actually going on and what influences the fluctuations of currency price movements. Now let's talk about brokers. So they act as also intermediaries between retail traders and the interbank market. So yeah, the foreign exchange market. They provide platforms for individuals like you guys to access the forex market, offering various trading tools and leverage options. You guys all know that. But brokers aggregate orders from traders and either match them internally or source them externally while hedging their exposure in the broader market, and their activities contribute to market liquidity and can impact short-term price movements through the aggregation of trading volume. A lot of word dribble there, a lot of information to take in. I hope you guys are all understanding these concepts and topics and these market participants individually, but it's super important for you guys to understand these market participants because they have a huge influence on currency fluctuations. Now, let's talk about imports versus exports. A lot of people miss this, but international trade is absolutely huge. So what are imports? Imports refer to goods and services that are bought into a country from overseas for sale. Now, these items are bought by residents of the country from foreign suppliers. Imports can encompass a wide range of products, including consumer goods, industrial materials, and agricultural produce. Now, right at the start of this year, pretty much since Donald Trump has come into administration, there was a lot of fear and uncertainty around tariffs, and there were lots of businesses that got affected by the tariffs, and that all impacts international trade, which therefore impacts the currency valuations. Now, when a nation imports goods and services, it spends money on foreign products, which can impact its trade balance and the value of its currency. Whereas exports are goods and services that are produced within a country and sold to consumers in other nations. So for Australia, we sell a lot of beef, and we also sell a lot of minerals to China, for example. So those are exports. They serve as a source of income for the exporting country and can include everything from manufactured items and raw materials to services like tourism and financial consulting. That's another one. Exports generate revenue, contribute to a country's gross domestic product, and can positively affect the value of its currency. So obviously, the more that we are exporting, the more that the price of our currency is going to be positively effective. And that's why Albert Albanese and all of our wonderful politicians decide to sell everything that we have. And just recently, we just had Morton Island be sold to a foreign entity, and our government loves selling our land and our goods and our products to foreign entities because it positively affects the exchange rate of our currency, even though it may have long-term negative effects for us Australian citizens. Now, let's talk about how imports and exports are relevant to the foreign exchange market. We've sort of covered this already a little bit, but we'll talk on 3 different topics individually. So trade balance. The difference between a country's exports and imports is known as the trade balance. A positive trade balance occurs when exports exceeded imports, while a negative trade balance occurs when imports exceed exports. So essentially, we're spending more than we're selling. We want to be selling more than we're buying because then we have that buffer there. Now, currency value. The trade balance affects the demand of a country's currency. Higher exports increase demand for the domestic currency, potentially appreciating its value. Now, there are a lot of factors that sort of are involved in this, and they do fluctuate. So it really depends on what is actually occurring in the economy for it to actually influence the value of a currency in a certain way. Now, conversely, higher imports increase demand for foreign currencies, which can depreciate the domestic currency. So like the Australian dollar, for example. It's pretty basic stuff, but it's good to go through all of this. Now, economic growth. Both imports and exports are crucial for economic growth. Imports allow countries to access goods and services not available domestically. Like I was talking about before, China buying beef from us. Don't know why they buy beef from us, but they do. While exports generate income and create jobs within the country. That's also a large one. That has a really big impact on unemployment and employment claims, and overall, jobless claims as well. So that's another economic indicator that it's really hard to be able to explain all of this right now. But different economic indicators affect other economic indicators, which affect other economic indicators, and they're all sort of tied in together in some way, shape, or form, and that is what actually impacts the economy as a whole, and therefore the exchange rate of that currency. Now, once you sort of start to learn these economic indicators individually, and you get a good understanding of them all individually, you'll be able to have a good indication on how they're tied together and how they influence one another, and therefore influence the economy as a whole. Each of the previously mentioned participants play a unique and crucial role in shaping the dynamics of the foreign exchange market, like we were talking about, influencing exchange rates through their respective activities and decisions. All of those participants that I was talking about have direct influences on the exchange rate of the economy and the currency. So it's super important for you guys to understand this, to be, obviously therefore understand the asset that you're trading and participating in. And even if you have a basic understanding of these concepts, you'll have a far greater advantage over somebody who doesn't. So I hope you all enjoyed this video. It was a lot to take in. Rewatch this video as much as you need to. I did keep it nice and short because I want to keep this rolling. I want to dive into future videos as well. And again, just to recap, I will be releasing a second program. So if you guys have any feedback, if I'm going too fast, if I'm not explaining it thorough enough, if you want more information on certain topics, let me know in the comments below, and I'll be more than happy to take that feedback on board for when I do create this second program. I'll make it better, sharper, and whatever you guys are missing out on, I'll make sure to include it in the future program. So with that being said, I hope you all enjoyed this video. I hope you guys learned something, and I will see you on the next video. Thanks, guys.